Hello everyone, welcome back. So we are doing third part of this question. So we are doing 2025 February March paper 12. So we'll solve question from 21 to 30 today. Question 21. What is not a limitation of accounting information? A. It can be compared with another years. Okay, so yes, accounting information can be used and compare it for another year or different years information so that we can see whether we made a profit or loss. So this is not a limitation of accounting information, whereas it is an advantage of having accounting information. B. It ignores non-financial factors. Yes, this is the limitation of accounting information. Okay, because we do not take into consideration non-financial factors like efficiency of the employees or customer loyalties. So these are not taken into consideration in accounting information. C. It ignores seasonality of trading, because we prepare accounting information for entire year, so we do not take into consideration some seasons we make more sales and in some we don't. Okay, so it ignores that. And D, it is based on historical data. So accounting information was prepared after the transaction took place. So all the information recorded in in accounting information are based on historical data. Okay, it may or may not repeat in the future. So the right answer for this question is A. 22. The accounting year of a company ends on 31st December. At the end of year 1, the company was financed by equity of 850,000 and there were no long-term borrowings. So we just had an equity in end of year 1. In year 2, at the beginning of year 2, 6% debenture of 150,000 was issued. So, and the profit for the year 2 was 58,000 and dividend of 20,000 were paid. What was the return on capital employed for year 2? So they're asking us what is the return on capital employed. So the formula for return on capital employed is profit from operations divided by capital employed. Okay, so first let's calculate the profit from operations for this question. Okay, so profit from operation is in statement of profit and loss, at this stage we find profit from operation, and then from there we subtract interest and tax and we get the profit for the year. So as per this question, we have the profit for the year 58,000 and interest, they did not give us any information, so we say 0, and the interest on loan or interest on debenture is 150,000 is the debenture amount, and then we said that we will pay interest of 6% out here. Okay, so interest supposed to be 9,000. Okay, so interest on debenture is 9,000, so we subtract 9,000 from profit from operations to get the profit for the year. Okay, so we subtracted 9,000 from this amount and we got profit for the year. So question is, what is this amount? So simply we add them, 58,000 plus 9,000, and amount is 67,000. So in 67,000, if you subtract 9,000, then we have 58,000. So now we got the profit from operation. We need to calculate what is our capital employed. Okay, so capital employed consists of equity and non-current liabilities. Equity, they already gave us what is our opening equity. That means at the end of year 1, that means in the beginning of the year 2 is 850,000. Okay, and in that equity during the year we earn profit of 58,000, so we add that 58,000 profit, and then in question if you see, then we also gave dividends. Okay, we paid dividends, so dividend paid would be subtracted from retained earnings, so altogether equity would decrease. So I'll subtract 20,000 from here. So if I add 58,000 and subtract 20,000 from there, this is the total equity we have at the end of the year. Okay, so now we have the equity, but this is not a capital employed yet. because as I told you, capital employed is equity plus non-current liability, and in year 2 we issue debentures. Okay, so debenture is 150,000. So if we add all of them, equity and debenture, then that will give us capital employed. So this is our capital employed, this is our profit from operation. So we simply calculate ROCE. Okay, ROC is profit from operations divided by capital employed into 100. Okay, so 6.45 is your answer. 6.45 is your answer. The correct answer is C. 23. On 1st March, a business has an inventory of 3 items which had a cost of $8 each. So we had a 3 item and the cost is $8. The business uses the first in first out method of valuating inventory. During March, the following transaction occurred. March 10th, purchased 16 units at $7 each. 18th, purchased 14 units at $6 each. And 27th, we issued 24 units at $10 each. What was the value of the inventory at the end of March? Okay, so to do this, first in first out method, very simple. First we need to know how many inventories we had. Okay, so we had 3, and then we purchased 16, and then we purchased 14. Okay, so if you look at here, all together 14 plus 16, 30 plus 3, 33. So 33 inventories we had. From there we issued 24. Okay, so we issue 24 from here. So I am left with 9 inventory. So this is the number of inventory at the end. Okay, so method was first in first out method. So first I use the inventory which is oldest. So first I use this 3 inventory, and then second I use the 16 inventory, and then I use this from this 14 inventory. Okay, that means I used all this, I exhausted this one and this 16 also, but from here there are 9 left. Okay, and the question was asking you what is the value of this closing inventory. So 9 inventory and the value is $6 each. So we'll multiply that with 6 and we get 9 times 6 is 54. Okay, so $54 is the value of the closing inventory. Do you have option here? Yes, C. So your correct option is option C, $54. (24) A factory produces 1,100 units per day. The daily machinery setup cost are 2,000. Direct material cost per unit is $3, and machine operators are paid $4 per day. Each can produce a maximum of 200 units per day. What is the average cost per unit? Okay, simple. If we calculate the total cost and then divide it with the total output, we'll get the average cost. Okay, so to calculate the total cost, let's start with what is our cost out here. Okay, so it is our setup cost. Setup cost is 2,000 straight away. Okay, that we had to pay. And the second cost that we pay is the material cost. Okay, direct material. And direct material, this is at $3 per unit. So we are making 1,100 units into 3, and that will give you 3,300. Okay, direct material. And then when it comes to operators cost, we are paying $4 each operator, and one operator can produce maximum of 200 units. So we want to make 1,100 units. So in order to make 1,100 units, I need 6 operators, because one operator can produce 200 units. So up to 6 operators can produce 1200 unit. Okay. So but if I had only 5 operators, then these 5 operators can produce only up to 1000 units. So I need 6 operators to produce 1100 unit. Okay. So and each operator paid 400. So here operator cost, okay, so machine operator cost is, we are paying 400 and we need 6 of them. Okay, so 2400. Make sense? Setup cost 2000, material cost 3300, and then machine operators cost 2400. So these are our total cost. So let's add all of that. Total cost, and total cost equals to 7700. Okay, and then my total output, in this case is given 1100. So average cost is 7700 divided by 1100, which is 7. Okay, D. So your answer for question 24 is D. Next question, 25. A business uses absorption costing. Which cost would be charged to production? Now, there are two types of costing methods that you learn in AS level: absorption costing and marginal costing. Absorption costing is also known as total costing. Okay, that means here we include all the costs to calculate the value of inventory. Whereas in marginal costing, we calculate only variable cost, or we include only variable cost to calculate the value of inventory, and fixed cost would be added separately as a fixed cost. Okay, but in absorption costing we add all the costs together. So it is a cost of material, cost of labor, variable cost, and overhead. So we add all of this, and that is the cost of your inventory as per the absorption costing. But if it is a marginal costing, we add direct material, direct labor, and only variable cost. Okay, so not fixed cost, only variable cost. So your right answer is A: direct material, direct labor, variable overhead, and fixed overheads. Let's go to the next, 26. The following data applies to a business: budgeted direct labor hour 20,000, budgeted overhead 300,000, actual direct labor hour 19,000, under absorptions of overhead is 35,000. What were the actual overhead for the period? Okay, very simple. So first we need to calculate in this question overhead absorption rate, OAR. OAR is total overhead divided by total labor hour or the machine hour. So in this case is the labor hour. So 300,000 divided by 20,000. So 300,000 divided by 20,000, that will give you $15. So this is your $15 per direct labor hour. So if you use a labor for 1 hour, we are planning to pay $15. Okay. Now here is the fact. So question is, what is the actual overhead? So let's first calculate what is the budgeted overhead that we have. Okay. So at this rate, budgeted overhead is, we are planning to pay $15 for each labor hour used. So we use 19,000 labor hours. Okay. So we actually end up paying, or we want to pay, that's a budgeted hour, labor hour, is 19,000 into 15, that is 285,000. Okay, so this is your budgeted overhead. Now we want to calculate what is our actual overhead, and for that they have given us under absorption of overhead. Okay, so we should understand what is under absorption. Under absorption is basically when your overhead that you kept aside as a budget is less than the actual expense. Okay, then we say it is under absorbed. So in this case, my actual overhead is not given, but we know that my budget is 285,000 and this is 35,000 less than the actual expense. Okay, so if we add them together, actual overhead is 285,000, which is budgeted overhead, plus the under absorption of overhead is 35,000. So we'll add this together and this is our actual overhead, 320,000. So your correct answer is C. (27) A business prepared a statement of profit or loss for its first year of trading. It used marginal costing to value the inventory. The finance director wants to prepare the statement using absorption costing. What will be the effect on inventory valuation and profit for the year due to this change? Okay, as I mentioned before, in marginal costing we use only variable cost. Okay, but in absorption costing we use fixed cost as well. Okay, so when we use the marginal costing, the cost would be lesser compared to absorption costing, because in our marginal costing we did not include fixed cost at all. Okay, so that means if I change from marginal costing to absorption costing, the value of the inventory will increase. Okay, so the effect on the inventory valuation is now the value of the inventory would be more. What effect does it have on the profit? Because this is the first year of trading, so we do not have any opening inventory. This is the first year of trading, so that means only the closing inventory value is increasing. Okay, so if the closing inventory value increases, then it will decrease the cost of sales. Okay, and if cost of sales is decreased, then it will increase the profit. So your right answer is, so your correct answer for 27 is D. Increase on inventory valuation and increase on the effect or the profit for the year. Let's go to 28. The following information was provided about a product: selling price per unit 50, variable cost per unit 26, total fixed cost 10,000 and demand is 1800 unit. If the selling price increase, only demand changes. When the selling price increased by $4, profit fell by 1200. What was the decrease in the demand? We need to calculate what was the profit we were making before. So to calculate the profit that we are making before, we'll calculate here. So total sales, we are making total 1800 units, selling it for 50. So this into this, okay, 90,000. And then in the question they mentioned the variable cost and the fixed cost. So this is total variable cost. Okay, so total variable cost we are making 1800 unit, and each unit variable cost is 26. So 26 is my variable cost, so 26. Okay, and the amount is 18 into 26, and 46,800 is my variable cost, and this is your fixed cost. Fixed cost remains same, so fixed cost is 10,000. and now we have a profit here. Okay, profit is sales minus the cost. So cost is fixed cost and variable cost. Okay, so 33,200 is our profit. Got it? Now we change the selling price and now the profit would decrease. So this is decrease in profit. Okay, and the profit decreased by 1200. Okay, so this is our new profit now. New profit is coming 33,200 minus 12, and this is our new profit, which is 32,000. Okay. Question is asking us what is our sales or what is our demand. So for that we need to calculate using the desired profit formula. So to calculate the unit for a desired profit, the formula is fixed cost plus profit divided by contribution per unit. Okay. So fixed cost you already know is 10,000. Fixed cost is 10,000, and desired profit was 32,000. But the contribution per unit we don't know. Okay. So contribution per unit can be calculated selling price minus variable cost. Okay. Now the selling price was 50, but now it will change from 50 $4. Okay, so selling price will increase by $4, so it will be 54, and the variable cost remains same, which is 26, and that will give you the contribution. Okay, so selling price is 54 because increase in the selling price, variable cost 26, so 54 minus 26 will give you 28. So this is your contribution. Okay. Now if I want to find out how many units we should sell to make 32,000 profit, then fixed cost plus profit, and then this amount would be divided by contribution per unit. Sorry, here. So we should make 1500 unit. So now if the selling price increases, profit decrease, and we will be able to sell only 1500 unit. Okay, so question was asking us what was the decrease in the demand. So it was before 1800, now only 1500 unit could be sold, so loss of 300 units. So correct option is B. 29. A manufacturing business provided the following information: selling price, variable production cost, variable selling cost, fixed production cost, fixed selling cost. What was the contribution to sales ratio? Okay, so contribution to sales ratio is contribution divided by total sales. Okay, and into 100, because this would be expressed in terms of percentage. So it is sales is directly given, which is 80, but we need to calculate the contribution. Contribution is selling price minus variable cost. So 80 minus variable cost. This is a variable production cost, variable selling cost. So these two are fixed costs, so it would not be subtracted. So 44 plus 6. So 44, and then we subtract 6 also. So that means 50. So 30 is my contribution. Okay. So contribution to sales ratio is contribution divided by sales, which is 80 into 100. Okay, so 30 into 80, that will give you 37.5. Okay, your correct answer is C. Let's write it here, 37.5%. 30. Which assumptions are true about the cost, volume, profit analysis? Okay, so we make an assumption while we do the analysis for cost, volume, and profit. So 1, costs are classified into fixed cost, semi-variable cost, and variable cost. Okay, this is not true, because in cost, volume, profit analysis we identify cost into fixed cost and variable cost only. Okay, number 2, selling price per unit remain constant. Yes, that is the assumption we are making. So even if you sell a huge number of inventories, the selling price remains same. 3. The total fixed cost remain constant. So we assume that the fixed cost does not change no matter what the level of production or sales activity is. So that is the assumption that we make. And then the fourth one, volume is the only factor affecting the variable cost, or if you buy more, the more variable cost we have. Okay, so the three assumptions that we make here is selling price per unit remain constant, total fixed cost remain constant, and volume is the only factor that affects the variable cost. So your correct option for question 30 is C, 2, 3 and 4. Okay, so with this we come to the end of our video. I hope you like it, and if you have any questions, please do comment and I'll get back to you. Have a nice day and happy learning.